Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Last week really felt like a long, depressing movie. Risky assets were generally very weak. And on Friday, I had many of our relationship managers asking me to comment on headlines about bond markets entering bear market. Because global bonds have dropped by more than 20% since 2021. Investors are concerned that aggressive rate hikes is likely to continue. That is based upon the two lines from Powell at Jackson Hole, which were A, purposefully moving policy to a level that will be sufficiently restrictive, and B, estimates of longer run neutral are not a place to stop or pause. Now, since then, last Friday's non-farm payroll data has been somewhat mixed, with hiring and participation ahead of expectations, but wage growth was slightly below estimates. Now, this week's Beige Book is going to give further clues as to the stance of the Fed, followed by the CPI data on the 13th of September. So now, what should you do as investors? Actually, we would argue that fixed income is looking very interesting here. Why is that? Well, let's start with the key metrics, which is the US 10-year yield. On Thursday, it went into the 3.25 to 3.5% zone that we've always been highlighting. Momentum indicators such as MAC and the directional indicator are pointing towards further rise in US 10-year yield. But upon the mixed non-farm payroll number on Friday, it had mild pullback to 3.19%. Now, it's worth putting things into perspective. So first of all, Fed rates are now above estimates of the neutral level, which is likely to make the Fed more sensitive to weaker growth data later this year or in early 2023, especially when this comes against clearer signs of an inflation peak. And also, a binary recession indicator does not tell us anything about the depth or length of any recession. On this last point, while a very inflation-focused Fed risks hiking rates excessively, on the flip side, it also creates more room to cut quickly and sizably in need. Hence, US 10-year yield may well be in the process of topping out. A key level to look is around 3.5% over the next 12 months, and we see opportunities for investors to gradually add exposure to global fixed income. Now, which sub-asset class within fixed income looks good at this moment? Actually, you know what? I will leave that to the podcast tomorrow. Please stay tuned for Cut to the Chase. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.